Welcome to the Swing Trading Strategies video series. In this video, we will see how to use RSI indicator hidden bullish divergence in trading. This entire series is focused on what to trade, when to trade, and how to trade. And I've covered swing trading in great depth. And if you have landed on this video directly, do watch the remaining 8 parts of Swing Trading Strategies series. Link to the same is given in the description box below. So in the previous Swing Trading Strategies video, we have seen about RSI bullish divergence. And I've used the same template in that video to explain hidden bullish divergence to maintain a sense of continuity. By the time you finish this video, you will have learned about how to use RSI indicator hidden bullish divergence strategy and how to apply this trading strategy to identify high probability trades. I will take you through some basics of hidden bullish divergence, and then I will give out specific rules for hidden bullish divergence trading strategy. I will also point out most common mistake while applying this concept, and I will show you how to use this method for trading in the direction of trend. In the end, I will show you how to identify high probability trades and will show you trade and risk management with respect to this strategy, because in this particular strategy, risk, trade management and entry differs from what we saw in RSI standard bullish divergence. So let's get started.
In this channel, we talk about trading, investing, and market analysis to help you become a better investor and trader. So if you are new here, consider subscribing.
So let us first begin with RSI hidden bullish divergence basics. Now I have covered RSI indicator and RSI bullish divergence in great depth in a separate video. Link to those video is in the description box below. Would strongly recommend for you guys to watch those videos as well. So now focus of this video is how to use RSI indicator to trade hidden bullish divergence. Now in very simple terms, under RSI hidden bullish divergence, price forms a higher low whereas RSI forms a lower low. Now that is, RSI actually indicates further weakness, but price is indicating underlying strength. That is a sign of accumulation. Now RSI is a momentum indicator, and by making a lower low, what RSI or momentum is essentially telling us that price will soon form a lower low as well. But on the flip side, what happens is price does not make a lower low, and this should be taken as a sign of accumulation, and this is a sign of extreme price strength. And this is why this particular concept of hidden divergence is actually so powerful. Now RSI hidden bullish divergence cannot be applied without relevant context. Just like standard bullish divergence, there are some rules which have to be followed. Also, the entry and trade management is very different from what we saw in standard bullish divergence. Now RSI parameter to be used for this particular strategy is again 14 periods. Now focus on the chart above. In the above chart, price is actually forming higher low, whereas in the indicator section, this is the RSI indicator section, indicator is essentially forming a lower low. Now this phenomenon of price forming a higher low but RSI forming a lower low is called RSI indicator hidden bullish divergence. Now while looking at this indicator, traders are actually expecting price to move lower as momentum is increasing on the downside, but price continues to trade above the previous swing low and forms a structure of higher lows. Now again, this is a very powerful concept, and odds of RSI hidden bullish divergence are much higher than RSI standard bullish divergence. In the previous slide, I mentioned that success rate of RSI indicator hidden bullish divergence is pretty high. I would actually put that success rate at roughly 55 to 65%. That is, once you find or spot this pattern, there is a high probability of around 60% that this trade will work in your favor. Now, main reason for this is that standard RSI bullish divergence forms in bearish market conditions like we saw in the last video, whereas RSI hidden bullish divergence forms in bullish market conditions and bullish price structure. This means RSI standard bullish divergence is actually a counter trend strategy, and that is why the success rate of that particular strategy is low, whereas RSI hidden bullish divergence is a trend continuation strategy, and hence the odds of this trade working out is much higher. Again, these are some of the most undercovered points, and these give divergence a overall meaning and precisely define in which market conditions to apply which divergence strategy. Now, typically what happens is traders spot divergence and they start applying divergence in any given market condition, but that is not how you should do it. Standard RSI bullish divergence should be applied in bearish market conditions because it's a trend reversal strategy, whereas RSI hidden bullish divergence should be applied in bullish market conditions because it is a trend continuation strategy. So let me repeat this again. RSI hidden bullish divergence is formed in bullish market conditions, signaling continuation of trend. Now, this is the main reason why odds of trade being successful is high, as you are trading in the direction of trend, that is in the path of least resistance. What essentially you are doing is, by this strategy, you are buying into temporary weakness in an ongoing strong uptrend. I hope this particular point is clear. Now let me show you how to spot high probability RSI hidden bullish divergence signals. Now, one of the most common mistake committed by traders is to trade every divergence signal that shows up on the chart. Now, this should be avoided. Now, without a structured approach on how to trade divergence, you will simply end up taking unnecessary losses on your account. Now, look at the chart in front of you. There are 3 RSI hidden bullish divergence signals that you are seeing. Now, this is a clear case of price forming a structure of higher lows on the chart. This is point 1, point 2, and the RSI divergence. This is the point, and this is the next point. Again, you can spot one swing low is this point to another low, again forming a structure of higher lows, whereas RSI is clearly forming a structure of lower lows. Again, from this point to this particular point, price is forming a structure of higher lows, whereas RSI is forming a structure of lower lows. Now, for now, what you need to see is how this particular divergence signal looks on the chart. I will come to the high probability signal identification part in a couple of slides later. What you need to see right now is that look at the 4th marking on this particular chart that I've marked with red arrows. Now, this is a case of failure of divergence. As price fails to make a higher low, it is essentially making a lower low, and RSI has also formed a lower low. Now, the reason why I've marked out this failed divergence region is because think from momentum point of view. Now, we all know that in technicals, it is momentum that comes first and then price moves up or down depending on where the momentum is coming in from. So what is happening in this particular time frame is that repeatedly RSI is again and again forming a structure of lower low. Now, this is fine up to an extent, but what this indicates is inherent weakness that is setting in this overall counter. So while trading hidden bullish divergence, you will keep getting these good moves on the upside, but always be wary of the fact that once RSI starts forming a structure of lower low on a consistent basis, price will eventually start doing the same. So the key thing that you have to learn here is that when you're swing trading, you simply have to swing trade. Do not carry these positions for a longer period of time. Typically, a swing trade should be somewhere between 15 to 20%, and then you should be booking out of those particular trades. So I hope this particular point is clear. Now, this chart in front of you is an example of 2 RSI hidden bullish divergence signals. Now, despite the strong momentum on the downside, which is depicted by RSI indicator here, price in both these instances have not breached the previous pivot level, right? For this particular divergence, this is the previous pivot level. For this particular divergence, this is the previous pivot level. So this actually is a sign of strong accumulation. If you want, you can add a volume indicator as well. If volume shows pickup, that would further increase the odds of hidden bullish divergence signal working in your favor. Now, what I mean is, now suppose I just forgot to add the volume indicator here, but let me just try and explain it to you. So suppose you have plotted a volume indicator in this panel. Now, when price is forming a higher low here and RSI is making a lower low, and you see that volume, especially around this second low point, is trending upwards, then that would mean that this low is being formed with more sort of buying activity than this particular low, right? So while RSI is signaling downside in the price, but volume and the higher low structure is signaling hidden bullish divergence. So I hope this particular chart is clear. What I'll do is in the comment section, I'll try and post few charts with volumes so that you guys can understand this particular point better. Now look at these two hidden divergence signals in front of you. Which one do you think is more bullish and why? Now this is where I will explain how to spot high probability hidden divergence signal with RSI indicator. Look at the first hidden bullish divergence signal. Where does it form on RSI? It is forming between the range of 35 and 40. Now look at the second hidden bullish divergence signal. See where this is forming. On RSI, this is forming between 30 and 35. Now the important point to note here is that second RSI point is what you have to keep in mind, not the first one. Which means in this particular divergence signal, you have to see where this second point is forming. Again, in this particular divergence signal, you have to see where this second point is forming. That is more important. So as a rule of thumb, only prefer those hidden bullish divergence signals which are forming between 30 and 34, that is on RSI. If you spot a signal between, let's say 20 or 30 in this particular region, that would be a very strong signal. So let's now revisit previous two charts and see which signals were the strong ones and which ones were not. So these were the two charts that we saw. So this particular RSI point, the first signal, it was around 30-33. Again, a very strong RSI hidden divergence signal. Same with this particular point and with this particular point. So all these three RSI hidden divergence signals were actually very strong, and which is why you've seen that price has easily moved 15% in each case. Let us take the second chart. Now this particular divergence signal I think is just forming at the 35 region. I would sort of ignore this, but look at this particular divergence signal. It is starting somewhere around 37, 38 and it is getting completed at 31. So this particular signal for me is more important than this particular signal. See, the reason is the more price retraces back with momentum while not breaking this previous swing low and RSI coming close to 30 or below it, that is actually a very high probability RSI hidden bullish divergence trade, and you should be taking that. So I hope this particular point is clear. That is how to identify strong hidden divergence signals and how to ignore the ones which are usually not that strong, and you should be skipping those particular signals. So let us now get down to specific rules for this strategy. The first rule that I would put out is that of trend. Now remember one thing, that you are trading a hidden bullish divergence in the continuation of trend. So this means that for this trade to be successful, there has to be a prior trend in place. Therefore, you have to look for a clear structure of price trending, that is higher high and higher low. For this particular strategy, stick to stocks only, no futures, no options, right? So the second rule that I want to put out is that of time frame. Now daily time frame has to be preferred for this particular strategy. If you want, you can experiment with 60-minute time frame, but daily is what I would recommend. The third rule that I'll put out is that of targeting high probability trades. Target divergence only between 30 to 35 region or below the 30 region RSI. The fourth rule that I want to put out is that of sign to get ready. See, RSI hidden bullish divergence is just a sign for taking a long trade. The fifth rule is that of trigger, and in the standard RSI bullish divergence, what we saw that we used to go down to the 60-minute time frame to take a trade. But in this particular hidden bullish divergence strategy, we won't be doing that. We will be sticking to the daily time frame only. So the trigger part, I'll just explain it in the next slide. So the next important rule is that of stop loss. The most recent low on swing low on chart should be the stop loss. The final rule is that of risk. Now, do not risk more than 1% of your account till you master this strategy. If you are a beginner, start by risking only 0.5% of account on any one single trade and focus more on enhancing your skill. Profit will come automatically. So now what I'll do is I'll just show you how I trade this RSI hidden bullish divergence strategy. Now on the chart in front of you, you can clearly spot a high probability bullish divergence signal. So what is happening is that clear structure of higher high and higher low is in place. Price is clearly trending higher, so the rule gets satisfied. Now hidden bullish divergence signal is also seen between 30 and 35. This is somewhere at 31 level, and prior down move that you see during formation of a higher low, that is also with momentum. Now this is not a necessary criteria, but if you spot a hidden bullish divergence signal where prior down move has happened with some momentum and it still does not break the previous swing low, then that is actually good for the overall pattern. So therefore this entire chart or this entire setup is valid and this should be traded. I'll repeat one more thing. As a rule of thumb, ignore all hidden bullish divergence signals that happen above RSI 35. They are not worth taking in my opinion. Let me now explain the trigger part to you. Now the trigger to initiate the trade is again taken on the same time frame. This is the daily time frame. In RSI standard bullish divergence, trade was taken at 60-minute time frame, but in this particular strategy, trade will be taken on same time frame itself. Now there are two ways to enter in this strategy. Either keep adding or rather keep buying in the stock till the price does not breach point A, that is the first divergence point. This is only when you see a clear divergence, that is hidden bullish divergence on the chart. Now let me explain this. So this is point A, that is the first swing low, and this is point B, that is the second swing low. So as soon as you see a clear divergence in place, of course, when you are here at this level, you don't know whether price would break below this A point and RSI would still trend lower. So this is where this strategy gets a little risky, but it does offer a better risk to reward in terms of standard bullish divergence through RSI. So once you see this happening, that RSI has formed a divergence without rising, because we will be at this point, and while it's easy to see in hindsight now, in real time it's actually difficult. So what you should be betting is that as price is forming and RSI gets close to 30 and you are seeing a divergence in place, you start buying here. Now this is why I recommended for you to stay in stocks, because lot size of futures is so high that in case this turns out to be a false signal, you will be losing a lot of money. With stocks, you have the flexibility to buy one stock, 2 units of stock, 3 units, 100, 200 in any multiple you can, and which is why you can control your risk better with stocks. So this was for aggressive traders, that as the pattern is forming, you start buying so that you trust the trend, and then trend will eventually move up and you would profit from it. The second way to add is for conservative traders. More so it applies to most of you who will learn this strategy in the beginning. So the second way is to add when one bullish candle gets completed after divergence. Now let me explain this on chart. So this B point that you're seeing, this V trade, I have enlarged it here. So as price is forming and RSI is forming a divergence signal, you start adding in this conservative method when you get a bullish candle on the chart. Now this candle is very bullish. It has made a low which is lower than the previous candle, but it has closed very strongly. So this is where you start buying into the stock. So let me repeat, aggressive traders can buy into the dip till the A point, that is the previous swing low, is not violated, whereas conservative traders should only buy when the divergence has been made and one bullish candle is printed on the chart. So I hope this particular point is clear. I usually prefer the first method because I have been trading for many years now, and the main thing here is experience and how you manage risk. Rest of the things do fall into place as you start trading this strategy more consistently. So the main reason why this particular strategy offers a better risk reward is because you are willing to buy into the dip while assuming that previous swing low won't be breached, and you are essentially trusting the trend and willing to trade in the direction of the trend. I hope this particular point is clear, because this forms the basis of the entry strategy for this particular trading strategy. Now, I will strongly encourage you guys to find out hidden bullish divergence trades in the current market scenario and post it in the comment section below. I read and reply to each and every comment, and I would tell you whether the trade you will have identified fits the overall criteria or not. Also, you can post your comments in Hindi, English, Tamil, Telugu, Marathi, and Gujarati. Now, a lot of you have asked me if you can do this to ask your doubts, and please feel comfortable to do the same. In times to come, I hope I can support more regional languages. So the key point that you should take a note of this particular strategy, number one is trend. Trend has to be clearly visible. Time frame again has to be daily to spot divergence and to take the entry trade. Do not forget the importance of risking less first. It's not important to make money at one go. Be more practical. Practice this strategy first and then try and increase your risk. At all costs, avoid short-term time frames, because that is just not useful. You will incur unnecessary losses on your account. So practice this strategy and take notes. And if you have doubts on this, let me know in the comment section below. I know there will be some doubt regarding the entry strategy or the entry method for this particular strategy, but let me know in the comment section. I will answer that. So that's all for this week. I will see you guys next week with another video that will help you strategize better in your trading. Thanks a lot for watching, guys. Be safe.
Click on the subscribe button and bell icon to get instantly notified when a new video is uploaded. Thank you for subscribing.